at an all-time record. Currencies also have moved massively. Incidentally, we did see the British pound at a record low. I mean, it has not been this low in 30 years. These are significant movements that can dislocate the markets and indeed can have significant consequences across the financial network and indeed even to the businesses, regular businesses. We've also seen central banks and other authorities move quickly, but also with appropriate size, massively. Fiscal authorities eventually did move, but markets have not been comforted by those announcements that have taken place. Most recently, we've seen a coordinated movement by the central banks and indeed the authorities in the G20, which was something we had been calling for quite some time. Coordinated action is what our world needs today. Now, true to Churchill's statement, maybe they did move eventually after exhausting all other opportunities, but they are here, and we are pleased that it's time for action. Another indicator, and again, this is again talking about the backdrop of the discussions that took place, is the price of oil, which has also has plummeted quite sharply. From our perspective here in Kenya, our benchmark oil, that is now somewhere in the order of $25 per barrel, more than half, or it has fallen more than 50%. It's fallen more than 50% from January. So these are all big changes which now we as the policymakers in Kenya have to deal with. Now, what's the bottom line? First, we haven't hit rock bottom, that we know. But yes, we know now that the world is in recession. We note yesterday the managing director of the IMF did mention in a conference call with the G20 that the outlook for global growth in 2020 is negative, and I quote, "A recession at least as bad as during the global financial crisis or worse," end quote. So we ourselves as policymakers in Kenya, and indeed the MPC, did absorb all this, and consequently the actions looking forward had to be directed to limiting the damage and, if anything, strengthening the economy as we brace for full impact of the effects from the coronavirus pandemic. So we now move to the section of the domestic economy. Clearly, inflation is not a concern anymore. And this, we expect it to decline towards the midpoint of our range, that is somewhere around 5%. Food inflation, by the way, is expected to come down. There are some key products, tomatoes, for instance, that prices had risen sharply recently, last month, and they have come down this month as well. And also non-food, non-fuel, that remains low and stable. And so we don't expect any, or let's say the concerns about inflation are really low. So the concern is really about output. And the usual considerations of output gaps, etc., these were dominated by the potential shock from the coronavirus. And the impact, of course, as we know, is pushing through all growth drivers. For instance, we know here in Kenya about the shutdown on flights. That has a direct impact on specific sectors. Also, the airports are empty. And we have also seen cancellation of hotel bookings, March through May. So that obviously affects our sectors, tourism, transportation, directly. There's also been limited space in terms of freight because of the lack of flights. And this, as we shut down completely all the flights, international flights, that space will only be on the cargo planes that would probably be put in place, which would require some rearrangement in the way our exports are done. There's also the other side of this, which is the imports from China. And we actually import material from China. And the expectation, of course, is that we could probably redirect some of these imports from other destinations, other sources. But that requires a bit more work in terms of connection, and particularly now when you do not have flights to international destinations, that will be a lot more work, a lot harder. But at the same time, we know that we do not know. Maybe a backtrack on that. We do not know how long this crisis will last. So we had to take sort of an educated guess in terms of the recovery. For sure, we know that we are not getting a V-shaped sort of crisis. Will probably be more of an extended U for a few months, and then we'll recover back to more normal, gradually to more normal sort of transactions. So before we had this, we had a baseline scenario with growth at 6.2% for 2020. But clearly that scenario no longer holds. So we then, as one of the projections that were discussed, staff presented projections, 3 scenarios basically: a mild one, moderate, and an extreme scenario, all depending on the strength or the impact from this coronavirus pandemic. Now, I would want to emphasize that it's not a choice. We do not have 3 and we have to choose from those 3. Pick one. No, it doesn't work that way. Really, it will be determined exogenously. The impact is what will determine. Is it a significant impact, extreme, or is it mild? And from our perspective, all we can do as policymakers is policy actions to limit the damage or to minimize the extent to which, let's say, growth will decline, or for that matter, the impact on the population, etc. So, from these scenarios, what was clear, what was evident, or what these scenarios show, is that the coronavirus pandemic will cut our GDP, or GDP in Kenya will be lower, and it could be as low as 3.4%. Now, in the mild scenario, we estimated it at 5.7%, but then in the extreme scenario, we estimated it at 3.4%. Now, you can see it's still positive, and basically, the element there relates to a highly diversified economy, both in terms of sectors and also in terms of, let's say, destinations of markets, also for source of imports and so forth. So that, in a sense, is what has would allow us to be this resilient, even in the face of significant declines, as I mentioned just now. The expectation is that will be negative, that the global economy will have a negative growth, so it will contract in 2020. So what about the policy actions? The policy actions generally would be 3-pronged. So first, policy actions will prioritize containment measures and strengthen the health systems. This, I think, we have seen the Ministry of Health push very hard on this. Second, set of policy actions is to protect affected workers and businesses. And we in the central bank and the decisions that were taken also move in this direction. They are all part of this. And thirdly, a set of policy actions that will prepare us for the recovery. This cloud will pass, and or this crisis will pass. And we want to, when it's done, we want to recover, but recover strongly. So we need to be ready to be back in full business after that. So those are the three directions of policy. So that's the situation with regards to output. I want to say a few things about the external sector. Clearly, the external sector will be affected. And I think the one thing I would mention is horticulture and flowers. Now, we did look at the exports that through February, and the numbers through February remain strong. But in March, the numbers just crumble. Now, what is more is that the next 10 weeks are normally our top weeks for floriculture, because this is when you have Easter, you have Mother's Day, and we obviously had expected significant sales during this time. But what is clear is that we are at a point where there's hardly any space for exports in the aircrafts, and also we know that in the Netherlands they are destroying a lot of the material that has gotten there already. Really, there are no buyers. So we have a significant problem in terms of the disruption that has taken place in this market. Now, our expectation is that it will come back, but it requires some work. And I think this is something that obviously we are concerned about. But at the same time, we are concerned about the workers that have been working on the flower farms, etc. So I think that is really a good, let's say, snapshot as to the stress that some of the sectors are facing. So we have the same problem, or would have the same problems on the horticulture. But also on imports, there'll be a decline of some of the imports for the reasons that I mentioned. But importantly, oil. Oil accounts for 20% of our imports. And as I say, the price has fallen dramatically. The peak was actually something like, for our benchmark oil, Marbon, was $86.8 per barrel back in October 2018. And at end December last year, 2019, it was at $69.9 per barrel. Now, beginning of March, it was at $52.4 a barrel. And now it is at $26.5 a barrel. That was yesterday or the day before. So you can see that there's significant savings that can be obtained, or that the economy can actually have. If 20% of your imports, the price has fallen 50%, that obviously calls for a lot of savings in that. Having done all the calculations, we had the baseline, in the baseline projection that we had earlier, the current account deficit was projected at around 4.7% in 2020. And as we have said before, we expect the current account to remain around 5%. That is sort of our medium-term expectation. Current account deficit at around 5%. Now, having done the scenarios and looked again at the mild and moderate and extreme scenario, actually we revised our expectation to somewhere between 4 and 4.9% of GDP. So you can see that there are compensating changes in our balance of payments, and therefore the current account doesn't move significantly, doesn't move dramatically. But there are some important elements in there that we need to watch, one of which is remittances. Remittances very much will depend on the duration of the crisis. I think in the short term, you may not expect much change. But I think as let's say, Kenyans in the diaspora, if let's say the crisis lasts long and they are jobless, or the lockdown effects and things like that, all that obviously may lead to some reductions in remittances. But at this moment, we don't expect that to move significantly. Now, there's also some other new transactions which are in the financial accounts. And again, what happens in the financial accounts, a lot of that depends on the duration of the crisis. And but there are some new elements which I would want to mention. We expect some new flows in the very near term. And these are related to the crisis. And this relates to the, let's say, IFIs, international financial institutions. So, for instance, we are expecting emergency. We've already made a request to the World Bank on emergency support related to the coronavirus that will be directed to the Ministry of Health, the various operations that they are doing, the Ministry of Health. The request has already been sent in, and therefore we expect something in the order of 50 million US dollars in the very near term. We are also working with the IMF for emergency assistance. This is assistance that doesn't have the conditionalities of programs. This is emergency assistance, and it is directed to emergencies like the one we are looking at, and several countries are already have already indicated their interest, and Kenya has also indicated their interest in this. It may be something in the order of 350 million US dollars, and a lot of this could be directed to budget support. We're also working with the World Bank in the context of their DPO, for additional assistance there, something in the order of 750 million US dollars. So these are all official flows, which will definitely, some of them were not on our radar just at the beginning of this year. But this obviously are coming to support the operations that, the emergency operations that are ongoing, and undoubtedly will also support our reserves and so forth. So I think the point we are making here is that the balance of payments will not move significantly. If anything, we see compensating changes, and that will leave us more or less where we expected to be at the end of 2020. I want to make 3 points with regard to the foreign exchange market and reserves generally. First, we do have adequate reserves. I think we mentioned it. It's mentioned in the press, in the communique that we issued yesterday. The reserves that we have, and US dollars 8,250,000,000, something like a little more than 5 months of import cover, and that is adequate to cover us, and as an adequate buffer against short-term shocks. But of course, we know that we can get even much larger shocks, but we want to make up, and that's one of the reasons why we've always said that we do need insurance, and this is why we have been working with the IMF to put together a precautionary program that would provide us some insurance against extreme shocks. So that's one point. The second point is, obviously, we've seen the financial market, the FX market, the foreign exchange market, has remained fairly balanced. But at the same time, we've seen some volatility in it. For those of you that are watching the markets, you've seen how the dollar has surged against virtually all currencies. And so, yes, we have seen in recent weeks a bit of depreciation of our currency, of the shilling, against the dollar. But there has been other factors that have also driven it. And I think one was a certain fear by dealers, and I would even say misunderstanding by some dealers. I don't know why. In early March, we did make the point, we indicated to banks that we expect, and the circular was clear, we expected that there would be a sort of a reduction in demand of foreign currency in the markets coming from, and in this particular case, we did talk about the oil companies. As I mentioned earlier, there will be significant savings from our oil bill because of the price that has gone down, the decline in prices of our oil imports. And so our point was that we would be in the market to build our reserves above normal levels. And we had indicated that we would be buying up to $100 million a month. And obviously still cognizant of the stability in the market, so we wouldn't be destabilizing the market. And I think that was what we indicated to the markets, but some dealers misunderstood this. But that is the fears, I guess, that they had. A third element on this, which has, in terms of the financial foreign exchange market, relates to some indiscipline by some malicious traders or malicious actors in the market. Unfortunately, we are not saved of that scourge. We've seen it in other markets as well. So I think the point again here is we appealing, aside from the rules, we also appeal to let's say the good ethics, the good sense of ethics of all our players around the in all markets, particularly at this time when we at a time of crisis. So those are the points I wanted to make in terms of the foreign exchange market, which we therefore continue to see that it will be stable, and we will continue to act as we have always acted. Our exchange rate policy has not deviated. It's always been a flexible exchange rate regime, but we intervene to minimize volatility. I think two other points before I finish, or two other areas. I want to say a few things about the banking sector. Now, quickly, the private sector credit growth, private sector credit has grown, or the growth of that has risen to 7.7% in February from 7.1% in December. So again, you're seeing this sort of gradual increase in the pace of private sector credit growth. But looking forward, the impact of the coronavirus, or the pain point, the first one of this will be on personal loans. And I think the objective now for us as policymakers and MPC is to ensure that the asset quality, which will be the first challenge, is we stop it from becoming a liquidity problem. Banks are liquid. There's ample liquidity, overall liquidity, but you could end up getting pockets of tightness or specific institutions or specific areas. And so that's why we need to be sure. We need to ensure that it doesn't become a liquidity problem, either generally, but more specifically in specific points. So going back then to personal loans, which, as you know, account for something like 28% of our value of loans. And the issue there would be if people, let's say, let go, so job losses lead to obviously problems in their repayments, and also it leads to significant anxiety and stress. So the idea is to ensure that it doesn't get to that point. So the MPC's decision, or the decision that the MPC took, have to be seen against the backdrop of decisions taken last week. So we do know, you do know that, or you know that there were decisions that were taken, and the decisions relate to banks providing relief to borrowers on their personal loans based on the individual circumstances arising from the pandemic. And to provide relief on personal loans, banks will review requests from borrowers for extension of their loans for a period of up to 1 year. And borrowers were advised to contact their own respective banks to initiate this process. Now, there was also something else, which is medium-sized enterprises. This is the SMEs, and corporate borrowers were also advised to contact their banks for assessment and restructuring of their own loans based on their respective circumstances arising from the pandemic. So that was, there are a few other measures, but I think I wanted to mention those specific measures. And consequently, the MPC, looking at this, it decided to lower the CBR rate, that is our indicator, to signal lower rates, but particularly on deposit rates, And this will allow to create more room for the banks. But it is also important to appreciate that everybody needs to has to take a share. I mean, everybody needs to take a bit of the burden of the crisis. And in this case, depositors will need to accept lower rates, lower deposit rates. Secondly, the MPC lowered the cash reserve ratio by 1 percentage point to release liquidity that will help bridge the gaps that will be created by the restructuring. And this was something in the order of 35 billion shillings. And that will be availed to the banks when they demonstrate what they are doing in terms of restructuring and supporting the borrowers that have been hit by the pandemic. So in that sense, it's not generalized. So we are trying to be as directed as possible, meaning the policy itself is directed to the point of greatest need, not sort of a generalized support on every single point. Another point is that we will work to strengthen liquidity management, we as the central bank. And in this, there are 2 points. The first is the interbank market. We need to look at it again and make sure that this is functioning smoothly, and ensure that it works even better than before. And secondly, from today, we will extend the tenure of our repos from 28 days all the way to 90 days. And that will allow banks, in case of liquidity need, they can bring in through this repurchase agreement, the repo, they can bring in their T-bills and we can have a repo agreement for as much as 90 days. Now, obviously, our expectation is that within 90 days, the uncertainties around the coronavirus pandemic begin to clear, and then things will probably begin moving towards where they should be, to the normal points. One last section then before I finish, and this relates to the I should also have said that in addition, we've also seen that banks have been, banks of course support the measures that we announced last week, but they've gone further, and their banks are moving on their own to provide even more relief to some of the noted sectors, for instance, the SMEs, and indeed also personal loans. So those are things that I think you'll see more and more as in the next few days and next few weeks. So the last point relates to the things on the financial measures, fiscal measures, and things related to the government. And the first of this is the pending bills, which we have seen. The payment of pending bills have gone relatively well over the last couple of months. And there's very little pending bills from government. That's the national government. And in the counties, we have seen, of the 47 counties, we've seen 16 have fully paid their pending bills, and 31 still have some pending bills to resolve. So we have actually seen the benefit of this from the perspective of some of the businesses that were owed this money. So that is a significant support, as it were, for our businesses. And then secondly, we expect a fiscal package very soon, targeted and with involvement of the private sector and labor. It is important that that all three parties work together to put forward a strong and targeted fiscal package that will help push us or limit the damage and the cost of the coronavirus. So now I finish. From the perspective of the central bank, we stand ready to ensure the smooth operation of our financial markets and the stability of the banking sector. I'm also reminded that the crisis started in Wuhan in China, and it's interesting to note that today they announced that they will end the lockdown in Wuhan in April 8th. So they are already signaling that the lockdown will be ended. So that's the rainbow. And indeed, in the province of Hubei, the lockdown ends tonight. This is significant. And we are very happy that they've made those steps after what obviously has been a rather tough several weeks. Now, at the same time, it's interesting that the word crisis in Chinese has two characters, and the characters relate to danger and opportunity. So yes, we do see danger in this crisis, but we also see opportunities. We are reminded of our connectedness, our humanity, and we will beat this together as a country. Thank you very much.